Hey everybody, Smart Silver Stacker here. Global commodity markets are about to be disrupted even more than they already have been, and inflation is going to be rising as a result. Today, I want to get into a few of the factors that are going to be contributing to this growing problem and discuss why the recent strength that we've seen in the US dollar in February is likely to be, to borrow a term from Fed Chairman Jerome Powell, transitory. Today's video is brought to us by SD Bullion, home of the lowest prices on gold and silver, period. If you're a new stacker, make sure you check out sdbullion.com/new, where you can get your first purchase of precious metals at spot. And now let's talk about this first story. The London Metals Exchange halts flows of Russian metals to the US. And this is the result of new US tariffs on Russian base metals this time that will be going into effect on March 10th. There will be a 200% tariff on aluminum, a 70% tariff on copper and lead, and a 35% tariff on nickel. Of course, tariffs of that level will basically mean that importing these metals from Russia is no longer economically viable here in the US. These are designed to reduce Russian revenues, and they probably will impact those to some extent. However, it will also be driving the price for these base materials higher in the US as a result, and the real winner here will be India, China, and these other emerging market economies. They'll be getting a discount on these materials now because there will be less competition. The buyers in the US aren't going to be bidding these up as much. It's the same dynamic that we witnessed in oil over the past year, whereby China and India are able to purchase Russian oil at a significant discount, and so they're going to be the real winners here. But this will be leading to higher inflation in the US. A higher cost of base materials will factor into higher prices for a variety of goods. And to give you an idea of how much of these commodities come out of Russia, I'll put a chart up on the screen here. This is from the International Energy Agency at IEA.org. Now, this chart is based on data from the year 2020, but you can see that nickel, class 1, so that's the nickel of the highest purity, Russia is responsible for 17% of global production of class 1 nickel. They are the number one producer in the world. Then for nickel class 2, that's the less pure stuff, they produce about 10% of that. They rank number 3 in terms of production. Now, palladium, this is not a base metal, but this is just to illustrate how much of these raw materials actually come out of Russia. They make 43% of the world's palladium production. They are ranked number 1 in production of that precious metal. Now, aluminum, that's the hardest hit metal with these tariffs, with a 200% tariff. Russia produces 6% of total aluminum output, and they are ranked number 2 in global production. And then copper, they're not as big of a producer, but they're still ranked in the number 7 place with 4% of total production. So when you see what a big contributor to global production for a number of these metals Russia really is, you can start to understand how much of the global market we no longer have access to here in the US. And these sanctions and tariffs are not the only factor that will be contributing to rising inflation moving forward. We also have Chinese factory data now revealing that their manufacturing is growing at the fastest pace in a decade. The China February manufacturing PMI was just released. It came out at 52.6. That's up from 50.1 in January. Now remember, the way that a PMI works is that any number over 50 represents growth, any number under 50 represents contraction, and analysts were expecting a print of 50.5. So the actual data exceeded expectations pretty significantly. And this is a sign that China's post-COVID lockdown reopening is likely for real this time. This is something we've been hearing about for a while now, but the data is indicating that it really is moving ahead now at a pretty good clip. And this is going to create a significant increase in demand for energy and raw materials, likely for the remainder of 2023 at the very least. And this is going to put even more upward pressure on commodities and specifically on crude oil. And it's going to contribute to even faster price increases here in the US and around the world. I mean, now we have got OPEC production cuts of 2 million barrels per day. Those are still in effect from last year. We have Russia, who just announced last month that they were going to be cutting oil production by 500,000 barrels per day. Those are cuts that are going into effect this month. So we are really about to begin to feel the effect of this diminishing supply for energy and now a rising demand coming out of China in these global energy markets. And on top of that, the US has already released about half of the petroleum in the Strategic Petroleum Reserve. So we have played that card, and that has so far mitigated the impacts of rising energy on inflation here in the US and around the world to some extent. It has really provided a lot of buffer in global energy markets. And yeah, we still do have some oil there. There's still over 300 million barrels of oil held in the SPR. But, that's obviously a trick that we can only keep up for so long, because eventually these reserves will be completely exhausted. And that means that unless we get some kind of major economic slowdown around the world that eviscerates demand for energy and oil, energy prices are going to be rising, possibly rising a lot. And that is going to put upward pressure on just about everything, because oil and energy, they touch just about every good and service in one way or another, whether it be due to higher manufacturing costs, higher fuel costs for distribution, or any of the other countless ways that energy acts as an input across the economy. And all of this, these disruptions to base materials coming out of Russia, this Chinese reopening, all of this is likely why, in a recent Reuters poll that was conducted regarding the strength of currencies, analysts are forecasting a weaker US dollar by the end of 2023. Now, this is not a huge surprise probably to anyone who watches this channel. And although the US dollar index did rise by about 3% in February, that is not likely to continue. I mean, yes, it's true, the Fed may get a bit more aggressive with their rate hikes in the near future. And I believe that this expectation of a tighter Fed is largely what accounts for the rise in the US dollar index that we just witnessed. And it's also why we saw a corresponding correction in the price of gold and silver in that same time period. But given the amount of debt and leverage at all levels in the US economy, I personally don't believe that the Fed is going to be able to get anywhere near the level of interest rates that would actually be necessary to cool this rising inflation before something breaks in this economy. And we're already seeing significant signs of stress in the US subprime auto lending market. We had lender American Car Center close its doors recently. They laid off about 300 employees. And this is just the beginning of a growing trend. We had the New York Fed in their recent report on record high U.S. household debt indicate that delinquencies are beginning to rise across the board on all forms of lending. And as rates rise and consumers come under more and more pressure from this rising inflation, this trend will almost certainly continue to get worse. Now, eventually, this is going to begin to affect the balance sheets of institutional investors who have exposure to many forms of this debt. And that's the sort of thing that could usher in a true financial crisis. Now, I think that the Fed, in the event of a financial crisis, will stick to the game plan that it's had in place for more than 2 decades of papering over any crisis that does rear its head. And that will mean a return to a policy of easing, further expansion of the Fed balance sheet, and of course, much higher inflation. Because the reality is, all of this debt eventually is going to have to be defaulted on, or if it is going to be paid off, it's going to have to be paid off in devalued currency. And I think that that is likely the route that we will be heading down. But even if we don't witness some kind of a financial crisis in the near future, the mere supply and demand dynamics in the global economy are going to continue to push prices and inflation higher, even as the Fed continues its policy of rate hikes. So if there is no crisis that forces the Fed to once again fire up the printing presses, we may just be headed for an extended period of stagflation, with interest rates and inflation rising in tandem while economic growth continues to diminish. Now, really, the takeaway here, I think, from all of this is that now is the time to get our financial houses in order. Pay down and eliminate unnecessary consumer debt, save some cash, have some dry powder in case we do get some kind of a crisis, but also make sure you're getting some real hard tangible assets like gold and silver outside of the over-leveraged financial system. And also make sure you have access to resources like food and water, basic stuff to make yourself less dependent on systems of support for your basic needs as we head into a time of increasing uncertainty. So Leave me a comment down below to let me know what you think about these recent developments. That's it for today, everybody. Thank you very much for watching. Stay safe and happy stacking. Smart Silver Stacker, out.